Yo, what's good, everybody? Welcome to the Introduction to Quarterly Theory, a complete framework for market cycles. In this video, I'm going to go over the foundation of quarterly theory, how cycles work, what true opens are, and a quick guide at the end of the video that you can screenshot to start applying to your trading today. This framework will literally be the difference between trading blind and trading with precision inside of the markets. So without wasting too much time, let's get right into it. So what is quarterly theory? Quarterly theory focuses on the most important aspect of trading, which is time. Combining quarterly theory, which is time, and ICT concepts, which is price, you allow for precise entries and strong bias inside of the market. If you are able to master combining price with time, you will gain a much deeper understanding of the markets and be able to determine why and when price moves the way that it does. So time must be divided into 4 quarters for a complete understanding of market cycles. Quarterly theory eliminates any doubt in the market because it provides time-based reference points to guide trade execution. So with quarterly theory, you will never be guessing where the market wants to go and will have a set time and set conditions that you know you should be looking for when trying to enter a trade. Next are the quarterly cycles. So the most important concept of quarterly theory is that time is fractal and that every cycle has 4 quarters. So starting with the yearly cycle, which is 1 year split into 4 equal quarters of 3 months each. For example, the first quarter of the yearly cycle would be January, February, March, and the second quarter of the yearly cycle would be April, May, and June, and so on. Next would be the quarterly cycle, which is 1 quarter of the year split into 4 equal quarters of 22.5 days or 3 1/4 weeks each. Next, the monthly cycle, which is 1 month split into 4 equal quarters of 1 week each. Then the weekly cycle, which is 1 week split into 4 equal quarters of 1 day each. These days consist of Monday, Tuesday, Wednesday, and Thursday, as Friday is not a true quarter because it serves its own function, which is to usually return price to as close to the true week open as possible. Next is the daily cycle, which is 1 day split into 4 equal quarters of 6 hours each. These 6 hours also align with the 4 sessions of the day. So quarter 1 is Asia session from 6 p.m. to midnight. Quarter 2 would be London session from midnight to 6 a.m. Quarter 3 is New York AM session from 6 a.m. to noon. And quarter 4 is New York PM session from noon to 6 p.m. Next is the session cycle, which is 1 session split into 4 equal quarters of 90 minutes each. So quarter 1 of the New York AM cycle would be from 6 a.m. to 7:30 a.m. Now for the super low time frame cycles, we have the micro cycle, which is 1 90-minute quarter split into 4 equal quarters of 22.5 minutes each. And then the lowest cycle that we would use is the nano cycle, which is 1 microcycle split into 4 equal quarters of a little bit over 5.5 minutes each. So for each cycle, we have a corresponding time frame that we use to view these cycles on the charts, as seen in the parentheses next to them. For example, the daily cycle would be viewed on the 15-minute time frame, as you can see in this visual. And the reason that we use certain time frames to view the cycles is because when spotting cracks in correlation, which I'll go over in another video, these are the exact time frames that we need to use to be able to spot these correctly between the correlated assets. Next are the quarter functions. So every quarter serves its own function, and depending on the quarter of a cycle we are in, we can anticipate what the next quarter is most likely to do. This is our if and then. So if quarter 1 accumulates, then we can expect quarter 2 to manipulate. If quarter 2 manipulates, then we can expect quarter 3 to distribute. And if quarter 3 distributes, then we can expect quarter 4 to either continue the move or reverse. So quarter 1 always dictates the quarters that follow. In the comments, if quarter 1 were to manipulate, what do you think quarter 2 would most likely do? Next are true opens, and these are a very crucial aspect to the foundation of quarterly theory. So true opens are a specific opening of price that serves as a time-based premium and discount of a certain range. They can be used to validate high probability cracks in correlation. So true opens are the price that quarter 2 opens up at in every single cycle. So for example, the daily cycle true open would be the open of London's price. For New York AM, it would be at 7:30 a.m. So if we're bullish, we would want to see price manipulate below the true open of that cycle. And if we are bearish, then we would want to see price manipulate above that true open of that cycle. True opens are very important because if we are in premium and discount, then we are more likely to reverse to the other direction. Lastly is our quarterly theory reference guide that you can take a screenshot of to help you with your quarterly theory trading. So the two most common sequences that we have in quarterly theory is AMDX and XAMD. So AMDX stands for quarter one accumulation, quarter two manipulation, quarter three distribution, and quarter four continuation or reversal. And XAMD stands for quarter one continuation or reversal, quarter two accumulation, quarter three manipulation, and then quarter four distribution. So here on our example at the right is a textbook example of AMDX. So as we can see, quarter one accumulated, and then quarter two manipulated below quarter one's sell side liquidity and below the true open. After the manipulation, price began to move upwards and created a PD array that overlapped the true open. These PD arrays that overlap true open are much higher probability and can be used to catch very precise entries on trades. Next, we can see quarter three distributed off manipulation and drove prices higher instantly. Lastly, we can expect quarter four to either continue or reverse. For a reversal, you should expect to see price take out the high or low of quarter three and then begin to trade in the opposite direction. Also, if our distribution quarter takes out an important high or low, like a previous day high, previous day low, previous session high, previous session low, or trades into a high time frame PD array, such as like a 4-hour fair value gap or 1-hour fair value gap, then it is much higher probability that quarter four will reverse. So after determining which sequence that our cycle is, we can begin to lay the blueprint to when we want to take a trade for the day. Our accumulation quarter should never be traded, as it is just there to set a range to be manipulated by the following quarter. Our manipulation quarter is tradable after you have identified the manipulation has occurred and that there is a strong draw on liquidity to trade towards. Our distribution quarter is our highest probability quarter to trade because the manipulation has already occurred, so we can expect price to drive straight to the draw on liquidity, and we really shouldn't expect it to chop up or reverse. And lastly, quarter four can be traded at times because it is bound to continue or reverse, but it is much lower probability than just trading either the manipulation or distribution quarter. So that's going to be it for this video, guys. I really hope that you found something of value today. I put a lot of time into creating this video for y'all, so any type of support, like a subscription or like, is greatly appreciated. Also, make sure to leave a comment about any questions of quarterly theory you may have or any video suggestions that you would like, and I will be sure to respond. Thank you guys for watching, and take care.